Hey everyone, let's talk about China's economy in 2025, a powerhouse that's driving global markets but hiding a dark secret. Behind the dazzling success of companies like BYD, churning out electric vehicles, or Huawei, pushing the boundaries of AI, there's a troubling reality. For every shining star like these, there are dozens of corporate corpses, businesses that should have gone bankrupt but are kept alive, stumbling around like zombies. These zombie companies are dragging down China's growth, and that matters to you, whether you're investing in stocks, saving for retirement, or just buying a new phone. So, what's going on in China? Are we looking at an economic apocalypse? And how does it impact your wallet here in the US? Let's dive in. China's economy is a paradox. It's the world's second largest, growing at an official 5.3% in the first half of 2025, with exports hitting record highs. But dig deeper, and the numbers tell a different story. Independent analysts like Rhodium Group estimate real growth closer to 4%, slowed by a property crisis, trade wars, and persistent deflation. The real kicker? A growing army of zombie companies, unprofitable firms propped up by government lifelines. These aren't just small players, they're industrial giants, tech startups, and local manufacturers, kept alive to save jobs and prevent social unrest. Think of it like a hospital ward full of patients on life support, draining resources from healthier businesses. Why does this matter to you? If you're investing in a tech ETF or buying Chinese-made goods, these zombies affect stock prices, product costs, and global markets. Since 2001, China's had its worst run of unprofitable industrial firms, with losses piling up to levels not seen in over 2 decades. Local governments, drowning in debt, totaling nearly 300% of GDP, are throwing tax breaks and subsidies at these companies to avoid layoffs. This isn't just a Chinese problem, it's a global one. The US imposed 51% tariffs on Chinese goods in 2025, with Trump's policies targeting copper and semiconductors at 50%. That means higher prices for your electronics, think 10 to 20% more for a laptop or EV battery. This zombie problem isn't new, and it's got eerie parallels to Japan's lost decades. Back in the 1980s, Japan looked unstoppable. Companies like Sony and Toyota were crushing it, scaring the pants off US leaders like Reagan, who feared Japan would dominate global markets. Sound familiar? Then Japan hit a wall, a banking crisis, an aging population, and, you guessed it, zombie companies. These firms gobbled up capital, starving innovative businesses and stalling Japan's economy for 30 years. Many economists now warn China's heading down the same path. The big question, why? The answer lies in China's financial system, and it's a story that hits close to home for American investors. China's problem starts with how it funds businesses. Unlike the US, where private equity fuels startups like Tesla or Amazon, China leans heavily on state-controlled banks. These banks don't always back the best companies, they often prop up the weakest to keep people employed. This creates a vicious cycle called involution, a term you'll hear a lot in China's 2025 economic reports. It's not about efficiency, it's a brutal price war where companies slash profits to compete, sometimes selling below cost. The result? Capital productivity has tanked, dropping from 17.5% in 2010 to 12.5% today. In plain English, China's pouring money into businesses, but the economy isn't getting more efficient, it's getting worse. Take the tech sector, for example. Giants like Xiaomi or BYD are killing it, producing cheap, high-quality EVs and smartphones. But for every BYD, there are 10 smaller firms, often state-backed, that can't compete. They're not innovating or cutting costs, they're just surviving on cheap loans. Why don't they go bankrupt? Because China's government can't afford the fallout. Mass layoffs could spark protests, and with youth unemployment hovering at 15%, stability is priority number one. So, these zombies linger, dragging down the economy's potential. Let's zoom out and look at the root of this: credit. For years, China's growth was fueled by a real estate boom. Property made up 25% of GDP, with companies like Evergrande building skyscrapers on borrowed billions. When that bubble burst, Evergrande collapsed in 2021, and others teetered. President Xi Jinping slammed the brakes on real estate lending. But the money didn't vanish, it just shifted. State banks redirected loans to industrial sectors like solar panels and EVs. Sounds great, right? Except there's a catch. Is there really enough demand for all those solar panels? Or are they piling up in warehouses, made by zombie firms that can't sell them? This isn't China's first rodeo with zombies. Rewind to the 2008 financial crisis. When the global economy tanked, China responded with a massive stimulus, over 4 trillion yuan, or 12.5% of GDP, in just 2 years. That's like the US pumping $3 trillion into the economy overnight. Where did it go? Not to the most efficient companies, but to state-owned enterprises and politically connected firms. Studies show public companies were 40% more likely to get loans than private ones, regardless of performance. The result? A zombie boom. By 2010, nearly 20% of industrial firms were unprofitable but kept alive by credit. This wasn't always the case. Before 2008, China's banks were better at picking winners, funding companies that drove real growth. But the crisis turned credit into a social safety net. Instead of letting weak firms fail, the government used loans to keep factories open and workers employed. It was less about profits and more about avoiding riots. And where there's public money, there's often corruption. Post-2008 stimulus programs, like the 10 Industries Revitalization Plan, were rolled out in just 50 days, lightning fast, but sloppy. The outcome? A 4% spike in firms turning zombie, with the least efficient ones soaking up the most cash. Why do these companies stay undead? 2 reasons. First, cheap credit is like a shot of adrenaline, it keeps them breathing, even if they're bleeding cash. They borrow just enough to pay interest, then refinance, over and over. Second, and more toxic, is the moral hazard. When firms know the government will bail them out, they stop trying. Why innovate when you've got a safety net? Some get lazy, others take reckless bets, knowing Papa State will cover them. The International Monetary Fund estimates this zombification shaved 1.2% off China's productivity growth, costing up to 2% of GDP annually. That's billions of dollars that could have gone to cutting-edge firms but instead propped up the walking dead. China's zombie saga goes back even further. In the early 2000s, 60% of state-owned enterprises were zombies, 6 out of 10, losing money equal to 1.2% of GDP. Compare that to the US, where only 15% of firms were unprofitable, even after the dot-com bust. Japan, the zombie poster child, topped out at 20%. China's response? A privatization wave from 1999 to 2001, selling off 2,000 firms daily. The results were stunning. Privatized zombies boosted productivity by 30%, while public ones lagged. Why? Private firms cut debt by 18%, raised profit margins by 10%, and slashed administrative costs by 35%. Many state firms were bloated with unneeded staff, think make work jobs to keep unemployment low. Things have improved since then. State-owned firms now focus on strategic sectors like banking or rare earths, not broad manufacturing. But the zombie problem persists, especially in industries flooded with cheap credit. Another issue? China's bankruptcy system is slow, taking 18 months on average, 50% longer than in the US local courts, often tied to regional governments, drag out cases to protect jobs. Since 2020, new specialized bankruptcy courts have sped things up by 35%, letting unprofitable firms die faster and freeing resources for healthier ones. Still, the system's not perfect. So, what does this mean for you? China's zombies are a warning sign. If you're holding ETFs like QUEB or stocks in Chinese tech, expect volatility. Alibaba's down 10% year to date, and more tariffs could hit. Deflation means cheaper Chinese goods, but it also squeezes corporate profits, affecting global markets. For savers, low yields on Chinese bonds, around 2.5%, make them a risky bet. Investors should diversify, look at US or Indian tech instead. Consumers? Brace for higher prices as tariffs bite. China's not collapsing, but its zombie problem is real. It's got world-class companies, but they're swimming against a tide of undead firms. The government's walking a tightrope, cutting credit could spark unemployment, while more stimulus risks inflating the zombie horde. For now, China's growth is slowing, and that ripples across your portfolio and shopping cart. So, what do you think? Are China's zombies a deal-breaker for investing, or is its tech boom worth the risk? Drop your thoughts below, and let's keep the conversation going.